US Treasury yields hit fresh 2024 highs overnight as traders continue to reprice expectations for Fed rate cuts. The Philippines central bank holds but turns hawkish on inflation risks, and Australia's housing imbalance is expected to keep supporting prices. That's coming up in 5 Things in 5 Minutes. And then in our bonus deep dive interview, with gold hitting a fresh high overnight, ANZ senior commodities strategist Daniel Hynes explains what's driving the rally.
There's a whole confluence that's really driving gold's rally now, which I think gives me a little bit more confidence that it has further to go.
But first, in 5 and 5 with ANZ, US bond yields traded at their highest levels in 2024 overnight as expectations around Fed rate cuts shifted from 3 rate cuts this year to closer to 2 ahead of crucial US inflation data on Wednesday. The 10-year Treasury yield hit an intraday and 2024 high of 4.46%. Although it's back at 4.42% at 4 a.m. Sydney-Melbourne time. US stocks were up around 0.1% to 0.2%. Gold was sitting just off that fresh record high of $2,372 US an ounce, spurred by earlier talk of central bank buying. The Aussie and Kiwi dollars were up 0.4% at 66.05 and 60.33 US cents respectively. Overnight, the Philippines central bank held its policy rate at 6.5%, warning that upside inflation risks had increased. While the BSP has ruled out further hikes, it indicated no rush to cut. The Fed's actions will be crucial. Turning to the Fed, ANZ economist Bansi Madhavani says market expectations keep shifting towards 2 cuts this year rather than 3.
The market is now moving towards a consensus of around 2 to 3 rate cuts in the remainder of 2024 versus somewhere in the ballpark of 7-8 cuts that we priced in at the start of the year. Strength in economic data from the US, especially the jobs report that came out last week, and expectations of a little bit of firmness continuing in CPI print later this week as well, is price in fewer rate cuts this year.
Number 2, data later today is expected to show Taiwan's annual CPI inflation rate fell to 2.5% in March from 3.2% in February. That's ahead of price pressures that will feed through from electricity fare hikes. Bansi says Taiwan's central bank has already gotten ahead of that.
The CBC is aware, the CBC, which is Taiwan Central Bank, is cognizant of upside risks on inflation, and they preemptively hiked in March earlier to arrest this inflation expectation surge. So we're not expecting any further changes on policy rate from the CBC on back of inflation numbers.
Number 3, the big number global markets are watching this week is US CPI inflation for March. ANZ senior international economist Tom Kenny is expecting core CPI to rise 0.2% for the month, which is just below the market consensus of 0.3%.
On a fundamental basis, what we are looking for in inflation for March is firstly, core goods inflation is likely to be close to zero. This reflects the fact that many of the global supply chain bottlenecks have been resolved, and there's been some moderation in global transport costs since early this year. Secondly, we expect to see some softening in rent inflation that reflects trends that we are currently seeing with new rental contract agreements. Thirdly, and perhaps most importantly from the Fed's perspective, we're expecting some moderation in core services ex rent due to the fact that wages growth appears to be easing.
Number 4, the yen nudged a 34-year low of 151.96 to the dollar overnight. That's perilously close to that 152 threshold, seen by others as a potential trigger for intervention. ANZ's head of FX research, Marja Ben-Zaman, is sceptical about intervention at that level.
As the dollar-yen pair has moved higher, we know that the bar for actual intervention may be higher than previous levels. Actual intervention will be once we, sustainably breach 152, and I think that will be driven more from further widening, if there is, of dollar yen yield differentials. We do think that the yen will strengthen somewhat, but not anytime soon, until we have clarity on the US side of things in terms of some confirmation on when the Fed will eventually tend to cut rates.
Number 5. In Australia's housing market, housing lending, excluding refinancing, rose 1.5% in February, while building approvals fell 1.9%. ANZ Australia senior economist Blair Chapman says there remains a demand-supply imbalance in housing, which will push up house prices through the rest of this year, especially from late 2024 onwards, once extra demand kicks in from a rate cut and tax cuts.
We expect that lending will increase alongside that as their sort of average loan size has to increase so that people can actually purchase homes, and eventually approvals will need to turn. And we know that the tax cuts that are coming later in the year and our expected declines in the cash rate should help purchasers actually achieve their goals of buying a home.
Blair Chapman there. Now, in today's bonus deep dive interview, as the gold price continues to hit new record highs, ANZ senior commodities strategist Daniel Hynes says a range of factors have been driving gold. Led by bets, the Fed will at least cut interest rates this year, even if expectations around timing are shifting around.
Expectations around those rate cuts have certainly been shifting all over the place, but I think the prospects of something coming in the not too distant future certainly has helped fuel the rally that we've seen over the past few weeks. But it's not the only one. Certainly, there's been a lot of other factors. In fact, there's a whole confluence that's really driving gold's rally now, which I think gives me a little bit more confidence that it has further to go. It's not just one particular issue which is really making all the difference at the moment. A whole host of factors are really contributing.
What are those other factors?
I mean, look, the geopolitical backdrop is particularly darkening. Certainly with Israel's airstrike on the Iranian embassy in Syria, the latest. But we've seen outside of that, some escalation in the Russia-Ukraine war with attacks on energy infrastructure over the past couple of weeks as well. So, safe haven buying as a consequence has been pretty strong. So that's certainly playing its part. But I think broader still the economic backdrop continues to provide some comfort that the market will obviously see those rate cuts because inflation is coming down. The equity markets are likely to see some pullback in the not too distant future, and so this is triggering a bit of inflows into the ETF, the gold-backed ETFs as well, which is providing some support to the physical markets. So it's certainly as I said, a whole host of issues really driving that surge in demand for gold.
So gold is already reaching your target price for the year. What point do you start reassessing it further?
Well, I mean, markets can be fickle, and I wouldn't be surprised to see a bit of a pullback.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, April the 9th. Catch you tomorrow with a look ahead to the Reserve Bank of New Zealand's rate decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.